In this lecture we will discuss joint products. Joint processes involve situations where a company spends money on a process that eventually produces more than one product. At the time that the company is running the process, however, the individual products cannot be identified. For example, a dairy ultimately produces milk, cheese, cream, butter and yogurt. At the time that the dairy is spending money feeding and milking its cows, however, there is no separate product. So, the dairy can't easily identify the amount spent to produce the milk or the cheese. Another situation involving a joint process involves a slaughterhouse. At the time that a company is raising and slaughtering its livestock, there is no individual leather, chops, ground meat or steaks. All the costs spent on the cows up to the point that the firm can identify these products are called joint costs. A final example of joint products is a petroleum refinery. The refinery starts with crude oil. Only after considerable sums are spent, does the refinery have individual products such as gasoline, kerosene, and motor oil. The point where you can identify the individual products is called the split-off point, and all the costs spent up to that point are called joint costs. This lecture discusses how firms allocate the joint costs to the products produced by the joint process. The joint process is conducted in order to produce joint products. The creation of these joint products was the impetus for running the joint process. The joint process may also produce other products that have value, but the firm would never have run the joint process in order to get these products. These extra products are called byproducts. For example, after slaughtering a cow, a firm can sell the animal's intestines to dog food producers. The firm would never have slaughtered the cow in order to get just the intestines, but the firm isn't going to throw the intestines away once the cow is slaughtered. If a product has value, the firm is going to sell the product. Whether a product is considered a byproduct is a subjective decision. An exam question will identify whether any products are byproducts. For now, assume that joint costs are only allocated to joint products. We will discuss how to handle byproducts later in this lecture. There are different methods used to allocate joint costs to the joint products produced by the joint process. Some of the methods are based on fair market value. These methods are the preferred way of allocating joint costs. We will discuss 3 of these methods. First, we will discuss the sales value at split-off point method. Second, we will discuss the net realizable value method, and finally, we will discuss the constant gross margin percentage method. Sometimes, the fair market values of joint products are suspect. Maybe the price fluctuates a great deal, or maybe the process is dealing with intermediate goods that are not sold and therefore have no fair market values. Maybe the goods are subject to intracompany transfers so that the price is artificial. Maybe the prices of the goods are set by some authority that is basing the price of the goods on the costs spent to produce the goods. In these situations, the firm may allocate joint costs using a method that does not rely on fair market values. We will discuss the physical units method, which is also called the physical quantities method or the physical measures method. First, we will discuss the physical units method. Consider the following example. A firm spends $60 in order to harvest a nut tree. The harvest process produces 3 products: premium nuts, regular nuts, and nut pieces. The harvest process produces 2 pounds of premium nuts. Each pound of the premium nuts sells for $30. Therefore the process produces $60 worth of premium nuts. The process also produces 3 pounds of regular nuts that are worth $10 a pound. Therefore the process produces $30 of regular nuts. Finally the process produces 10-pound nut pieces that are worth $1 a pound. Therefore the process produces $10 of nut pieces. Assume that all of the products are joint products. Using the physical units method, the firm would ignore the fair market values of the products and allocate the $60 joint process cost to the products based on their relative pounds. The firm would first add up the pounds of all of the products and then divide the total pounds into the pounds of each product. This produces the percentages that are used to allocate the $60 of joint costs to the three products. The firm divides the premium nuts 2 pounds by the 15 total pounds and then multiplies that fraction by the $60 of joint costs in order to calculate that the premium nuts should be allocated $8 of the joint costs. This works out to be $4 a pound. The firm would also divide the regular nuts 3 pounds by the 15 total pounds and then multiply that fraction by the $60 of joint costs in order to calculate that the regular nuts should be allocated $12 of the joint costs. This works out to be $4 a pound. The firm would finally divide the nut pieces 10 pounds by the 15 total pounds and then multiply that fraction by the $60 of joint costs in order to calculate that the nut pieces should be allocated $40 of the joint costs. This works out to be $4 a pound. As you can see, the physical units method produces the same cost per pound for all of the products. If the firm considered the nut pieces to be a byproduct, then it would only allocate the joint costs to the premium nuts and the regular nuts. The firm divides the premium nuts 2 pounds by the 5 total pounds and then multiplies that fraction by the $60 of joint costs in order to calculate that the premium nuts should be allocated $24 of the joint costs. This works out to be $12 a pound. The firm would also divide the regular nuts 3 pounds by the 5 total pounds and then multiply that fraction by the $60 of joint costs in order to calculate that the regular nuts should be allocated $36 of the joint costs. This works out to be $12 a pound. As noted earlier, the physical units method always produces the same cost per unit. This can produce strange results. For example, the first allocation gave the nut pieces a cost of $4 per pound when they sell for only $1 a pound. Similarly, the second allocation gave the regular nuts a cost of $12 per pound when they sell for only $10 a pound. This is why firms develop refinements to the physical units method in order to produce realistic results. For example, they weight the units so that a pound of premium nuts is given a greater share of the costs. For instance, a firm could treat a pound of premium nuts as if it was 2 pounds when using the physical units method. The next method that we will discuss is called the sales value at split-off method. With this method, the firm looks at the fair market values of the joint products at the split-off point. Assume that all of the products are joint products. With our example, the firm would allocate the joint costs based on the premium nuts value of $60, the regular nuts value of $30, and the nut pieces value of $10. The firm would add up these values and divide the $100 total value into the values of the three products and multiply those fractions by the $60 of joint costs. This would allocate 60% of the joint costs to the premium nuts, 40% of the joint costs to the regular nuts and 10% of the joint costs to the nut pieces. This produces a per unit cost of $18 per pound for premium nuts, $6 per pound for regular nuts and 60 cents per pound for the nut pieces. Now assume that the nut pieces are byproducts. With our example, the firm would allocate the joint costs based on the premium nuts value of $60, and the regular nuts value of $30. None of the joint costs would be allocated to the nut pieces. The firm would add up these values and divide the $90 total value into the values of the two products and multiply those fractions by the $60 of joint costs. This would allocate 2/3 of the joint costs to the premium nuts and 1/3 of the joint costs to the regular nuts. This produces a per unit cost of $20 per pound for premium nuts and $6.67 per pound for regular nuts. We will now review the net realizable value method. With the net realizable value method, instead of looking at the value at the split-off point, the firm would look at the final value that the firm would get from selling the joint product. The firm would subtract from that value any additional processing costs that are incurred before the joint product is sold. With respect to our chemical example, the net realizable sales value is the same as the sales value at the split-off point, which is $300. With respect to chemical B, the final sales value is the value of the products that chemical B turns into, which are chemical C and chemical D. These chemicals are worth $250. In order to get chemical C and D, the firm has to spend another $10 in process 2. This has to be subtracted from the final sales value in order to get the net realizable value, which is $240. Now we allocate the process 1 joint costs between chemicals A and B based on their relative net realizable values. The firm adds up those values and divides each net realizable value by the total net realizable value of $540. The firm then multiplies those fractions by the process 1 joint cost of $300. Therefore chemical A is allocated $167 of the joint costs and chemical B is allocated $133 of those costs. The firm now has to figure out the cost to produce chemical C and D. The costs allocated to chemical B is part of the joint costs of chemical C and D. They were not separate products at this time. You add those costs to the process 2 costs of $10, giving those chemicals a total joint cost of $143. The split-off point for chemical C and D comes after process 2. The firm allocates the $143 of joint costs to chemical C and D based on their relative net realizable values of $100 for chemical C and $150 for chemical D. There are no additional processing costs after process 2. When you divide the total net realizable values of $250 into chemical C's net realizable value, you get 40%, and the same process gives you 60% for chemical D. Therefore, chemical C is a cost of $57.20 and chemical B is allocated a cost of $85.80. We are now going to discuss the constant gross margin percentage method. Please recall the results from our first example of harvesting the nut tree. Using the sales value at split-off point, the firm allocated each product a cost equal to 60% of its value. This left each product with a gross margin of 40%, which is the gross profit of that product divided by its sales value. This is always the case when you have one level of processing. When, however, you have two levels of processing, as we had with our chemical example, then the products end up with different gross margin percentages. This is because the costs of the later processes are only allocated to the products that go through that process. In our chemical example, chemical A was only allocated costs from process 1, while chemical C and D were allocated costs from processes 1 and 2. Thus, chemical A ended up with a gross margin percentage of 44.34% and chemical C and D ended up with gross margin percentages equal to 42.8%. The constant gross margin percentage method allocates the joint costs so that the joint products all end up with the same gross margin percentage. With the constant gross margin percentage, the firm has to calculate its gross margin percentage from all of the joint products. It does this by adding together all of the final sales revenues from all of its products. In our chemical example, that would be $550. The firm then adds up all of the processing costs for those joint products. The total cost of processes 1 and 2 is $310. When the firm subtracts its total costs from its total revenues, it gets a total gross profit of $240. When the firm divides its total gross profit by its total sales revenue of $550, it gets a total gross profit percentage of 43.6364%. When the firm subtracts 43.6364% from 100%, it gets a cost percentage of 56.3636%. The firm would then allocate to each product costs equal to 56.3636% of that product's value. This leaves each product with a gross margin equal to 43.6364% of its value. We are now going to discuss how a firm handles its byproducts. The firm sells those byproducts, and then the firm has two methods it uses to handle the net revenues that it receives from those sales. Remember that the firm is dealing with the net revenues from selling its byproducts. This is the revenue that it receives from selling those byproducts reduced by any selling expenses or processing costs that it has to incur in making those sales. There are two basic ways to handle the net proceeds that a firm receives from selling its byproducts. First, the sales revenues are treated as other revenue. This other revenue is added to the gross revenue of the firm on its multi-step income statement. The second method is to treat the net proceeds from selling the byproduct as a reduction in the costs of the process that produces the byproduct. The reduced joint costs are then allocated to the joint products produced by that process. In our chemical example, assume that process 1 produced chemical A, chemical B and a byproduct that was ultimately sold for $20. With the second method, the cost of process 1 would be reduced from $300 to $280, and the $280 of joint costs would be allocated to chemicals A and B. The end.